All right, let's cut through the confusion. You've heard about rent to rent. Maybe you've seen people making $20,000, $30,000, even $40,000 a year from properties they don't own. And you're thinking, how does that actually work? Where does the money come from? Today, I'm going to show you. No fluff, no jargon, just the actual financial model that's working right now in Australia. Let's go. Here's the core concept in one sentence. You rent a property, you improve or restructure it, you increase its income, and you profit on the gap. That's it. That's rent to rent. You're not buying anything. You're not flipping houses. You're not doing Airbnb arbitrage with 47 cleaners on speed dial. You're simply taking an underperforming rental property and making it work harder for the landlord and for you. Think of yourself as the middleman who creates value. You find a property that's earning less than it could. You step in, make it better, fill it with quality tenants, and the property starts generating more income. The landlord gets guaranteed rent. You get the difference. Everyone wins. Now let me show you exactly how the numbers work with a real example. Let's say you find a 4-bedroom house in a decent suburb. Nothing fancy, just a solid, under-rented property. The landlord's currently renting it out for $1,000 a week. That's $52,000 a year. Now, here's where it gets interesting. You approach the landlord and say, I'll take this property on a 3-year lease. I'll pay you $1,000 a week, guaranteed, whether it's rented or not, and I'll maintain it to a high standard. The landlord loves this. Why? Because they get guaranteed income, no vacancy stress, and someone else handles the headaches. Now, here's what you do. You convert that 4-bedroom house into 6 co-living rooms. Nice rooms, clean, safe, well presented. You're not running a dodgy boarding house. You're creating quality shared accommodation. Each room rents for $345 a week. That's actually below market for a lot of areas, so rooms fill fast. Do the math with me. 6 rooms times $345 per week equals $2,070 per week gross income. That's $107,640 a year coming in. You're paying the landlord $52,000. So your gross profit margin is $55,640. But hold on, you've got costs, right? Let's be realistic. Insurance, $5,000 per year. Utilities, you cover them, $8,000 per year. Maintenance and Airtasker help, $6,000 per year. Admin, software, incidentals, $3,000 per year. That's roughly $22,000 in operating costs. So your net profit is around $33,640 a year. That's over $2,800 a month in passive income from one property you don't own. And here's the kicker. Your startup cost to furnish and set up that property? About $25,000 to $30,000. Not $150,000 for a deposit. Not a massive mortgage, just $25,000 to $30,000. You're looking at a return on your capital in under 12 months if you do this right. Now you might be thinking, this sounds too good. Why doesn't everyone do this? Great question. Here's why rent-to-rent works so well in Australia in 2025. Number 1, the rental crisis. Vacancy rates are at record lows. People are desperate for quality, affordable housing. Shared accommodation isn't just for students anymore. It's young professionals, essential workers, even people going through life transitions. The demand is massive, and it's not going away. Number 2, rooming yields are high. When you rent by the room instead of renting the whole house, your income per square metre goes up significantly. That's just math. More people paying smaller amounts adds up to a lot more than one household paying one rent. Number 3, low capital barrier. To buy an investment property in Sydney or Melbourne right now, you need $150,000, $200,000, maybe more for a deposit. Then you're taking on a massive mortgage, praying for capital growth, and probably negatively geared for years. With rent to rent, you're in the game with $20,000 to $30,000. You're cash flow positive from month 1. No debt. No waiting 10 years to see results. Number 4, Landlords love this deal. Think about it from their perspective. They get guaranteed rent, no vacancy periods, no tenant dramas. Someone else handles maintenance and tenant management. For landlords who are tired, stressed, or just want a passive asset, this is gold. So you're not taking advantage of anyone. You're solving a problem for the landlord and meeting massive demand in the market. That's good business. Now, let me be clear about something. This isn't passive income on day one. You've got to set the property up. You've got to find quality tenants. You've got to manage the operations or systemize them with the right support. It's a business, a simple business, but a business. And it's not financial advice. I'm not telling you what to do with your money. I'm just showing you a model that's working for everyday Australians right now. Some people make more than the example I just showed you. Some make less. It depends on the property, the location, how well you manage it. But the structure works. The model is sound. And the opportunity is real. So here's the big takeaway. You don't need to own property for this to work. You just need to understand the model. You need to know how to find under-rented properties, how to structure a deal that works for the landlord, and how to set up a co-living property that tenants actually want to live in. And that's exactly what I'm going to show you in the next video. I'll walk you through how to actually find these deals, how to approach landlords, and what to say to get them to say yes. Because once you understand the profit engine, which you just did, the next step is learning how to turn it on. I'll see you in the next one.